Microeconomics. Microeconomics is the study of individual units within an economy. It focuses on how individuals and firms make decisions to allocate limited resources. The term micro comes from the Greek word mikros, meaning small. Microeconomics is all about understanding how the behavior of individuals affects the supply and demand for goods and services, which in turn determines prices, production, and consumption patterns in specific markets. Scope of microeconomics: consumer behavior and demand analysis, how individuals decide what to buy based on income, preferences, and prices. Theory of production and cost, how firms decide how much to produce and at what cost. Price determination, how prices are set in various market structures like perfect competition, monopoly, monopolistic competition, and oligopoly. Factor pricing and income distribution, how wages, rent, interest, and profits are determined. Importance of microeconomics: understanding market mechanisms, it helps in analyzing how prices of goods and services are determined. Policy framing, assists policymakers in implementing taxes, price controls, and subsidies. Business planning, helps firms optimize production and pricing strategies. Efficient resource allocation, ensures that scarce resources are allocated where they are most valued. Examples: a firm setting the price of a product. A household choosing between buying groceries or dining out. The effect of a new tax on the cigarette industry. Macroeconomics. Macroeconomics is the study of the economy as a whole. The term macro comes from the Greek word makros, meaning large. It deals with aggregate variables and the broad functioning of an economy. It looks at total income, overall employment, national output, inflation, and how government policies affect economic growth and stability. Scope of macroeconomics: national income accounting, measurement of total economic activity. Employment and unemployment, analyzing the labor market and the causes of joblessness. Inflation and deflation, changes in the overall price level. Fiscal and monetary policies, how governments and central banks use tools to influence the economy. International economics, trade, exchange rates, and balance of payments. Importance of macroeconomics: economic stability, helps maintain steady growth, low inflation, and full employment. Policy formulation, guides governments in preparing budgets and reforming tax systems. Understanding global issues, offers insights into recession, depression, and financial crises. Investment decisions, investors use macroeconomic data to predict market trends. Examples: the impact of a cut in interest rates on the national economy. An increase in public spending to boost employment. The effect of global oil price changes on inflation. Difference between micro and macroeconomics: microeconomics studies individual consumers, households, and business firms. Macroeconomics studies the economy as a whole, including entire nations. Microeconomics focuses on specific markets, products, prices, and individual industries. Macroeconomics focuses on national income, overall employment, inflation, and GDP. Example: a shopkeeper deciding the price of a product. The government preparing a national budget to manage the economy. Microeconomics helps businesses and individuals make financial decisions. Macroeconomics helps governments make policies for economic development. Microeconomics deals with personal, firm-level, or business-specific economic problems. Macroeconomics deals with country-wide or global economic issues and solutions. That is all about micro and macroeconomics. If you have any doubt, feel free to ask in the comment section. Thank you.